Welcome to a very special stock investment analysis video. Today we are analyzing two real estate investment trusts, or REITs, with my fellow investor Adriana. She's a real estate agent and stock market investor with an amazing YouTube channel linked in the description below. Say hello, Adriana.
Hello guys. First, Ben, thank you for inviting me to this real estate investment trust analysis. As Ben said, I'm a real estate agent and I've been investing in the stock market since 2017. I decided to create my YouTube channel wanting to share with you guys my passion for investments and record my journey.
Before we get into this video, please take a moment to subscribe to her channel and to mine as well if you've not already. I'll explain what REITs are and then hand it over to Adriana to give you the first analysis. What is a REIT? Think of an exchange-traded fund or an ETF. Rather than investing in 100 companies, you can invest in a single ETF and automatically have investments in 100, 500, or over 1,000 companies. Now let's imagine that instead of investing in hundreds of companies, we wanted to invest in hundreds of pieces of real estate. That is essentially a REIT. An equity real estate investment trust, or REIT, is a pool of properties bundled together that we can invest in. Perhaps you're interested in investing in commercial or industrial real estate. Chances are you don't have hundreds of thousands or millions of dollars to invest in commercial or industrial property. What is the alternative? Well, you can invest in a company like a REIT. The REIT buys and manages the real estate for you. The REIT will obtain rent or interest payments from its tenants and provide a portion of this back to you in a distribution or a dividend. In order to get special tax treatment, U.S. law requires that REITs pay out at least 90% of their income in dividends. REITs have a lot of tax exemptions which allow them to pass on more income and dividends to their investors like us. The downside is that because of the preferential tax treatment, our dividends are taxed at the ordinary tax rate. Other benefits of investing in a REIT is that it gives diversification to your stock investment portfolio and typically pays a higher dividend, which means more income in your pocket. Benefits of owning a REIT over buying real estate yourself are liquidity, convenience, speed, fees, and paperwork. Buying a REIT takes only a few moments and it can be sold just as easily. Buying, managing, and selling a rental property will require far more effort and time. Let's switch to Adriana as she gives you some great insights on a REIT to start off your real estate empire.
I'm going to be analyzing STOR Capital, ticker symbol STOR. STOR Capital is a real estate investment trust that focuses on owning freestanding buildings that are leased out to retail stores. They are one of the largest and fastest growing net lease REITs with a very diversified portfolio since they have more than 2,500 buildings in 100 different industries such as services, retail, and manufacturing. Obviously, with everything that is going on with the pandemic and lots of stores closed, their stock price has dropped more than 50%. Still, they said that 68% of their tenants have actually paid their April rent. During their quarter report, they even stated that they are very well positioned to sustain throughout the pandemic crisis and continue supporting their customers. They are currently trading at a price of $20.34, has a market cap of $4.97 billion, and has a current PE ratio of 14.16, which if we compare it to the industry is amazing, as well as their 5-year average PE. During the last quarter ending on March 31st, they reported an increase of almost 14% on their revenue and 37.5% on their net income, even with all the pandemic going on. Obviously, we would have to wait and see how this evolves during the next 3 to 4 months since the virus really started affecting the US around the second week of March. For their balance sheet, they said that they were able to fortify it with excess liquidity, modest leverage, and they don't have meaningful near-term debt maturity. But let me show you guys their balance sheet. Currently, they have a total of $633 million in cash and cash equivalents, which is an increase of more than 500% since December of 2019. They also had a slight increase of 15.5% on their liabilities since they added $600 million on their credit facility, which basically is part of what helped them increase their cash at the same time. Now, let's do some calculations here. If we divide their total liabilities of $4.41 billion by their total assets of $9 billion, we get a total debt to asset ratio of 0.49. Basically, what this ratio tells us is that this company has 49% of their assets financed by debt, which for me is very healthy to see this ratio around 50%. This leaves us with an equity of $4.6 billion. Now, remember that we would be buying this company with a market cap of $4.97 billion, which if we compare it with their equity of $4.6 billion, it's incredible. Yes, the pandemic has caused a huge heat and uncertainty to commercial leasing, since in the short term, it's impossible to know when all these stores are going to be able to open again. I'm saying this because any of these stores can go bankrupt, and that would create a very bad environment for STOR Capital. They are an excellent dividend stock with a dividend of 6.88%, which obviously it is inflated right now because of the price drop. STOR Capital has increased its dividend constantly the last few years, as you can see here in this chart. Something that you must take into consideration while investing in REITs is that by law, 90% of REITs profit must be distributed as dividends to shareholders. It's also important to know that normally when we analyze any other type of companies and check their dividend, we would take into consideration their earnings per share to calculate their payout ratio. However, for REITs it's a little different, since we have to use their FFO, or funds from operations, instead of their earnings per share. FFO is basically calculated by adding depreciation and amortization to their net income and then subtracting any gain from property sales. That is why STOR Capital has a payout ratio of 70.77%. Now, keep in mind that with current market conditions, that dividend could be stopped or reduced, so I wouldn't decide if I should invest in these REITs because of their dividend right now. In my opinion, in the short term, it's risky to invest in this REIT because it really depends on the virus situation and how everything plays out. If you think that the economy is going to recover sooner than expected and people are going to be returning to stores, then this is a good stock to buy right now. But if we actually see a second or even third wave of virus infections, I could see this company getting hit harder than it already has. I do have to say that when there is a normal market condition, STOR Capital has a very high profitability and a very good growth year over year, and that is what makes this company a very attractive one. Because of that, in the long term, they should be fine because of the amount of liquidity that they currently have, which will help them sustain during the existing crisis. Now, if you ask me, I won't be buying STOR Capital stock right now because of the risk exposure this stock would give to my portfolio. But if the economy does recover sooner than expected, then this stock will give you a very good return because they are very well positioned.
Thank you for the great analysis. We will now focus on our second REIT of the video. The absolute best REIT, in my opinion, is Realty Income, ticker symbol O. What makes it so special? Well, for starters, it has beaten the S&P 500, NASDAQ, Dow, and the equity REIT index by a huge margin since 1994. In fact, $10,000 invested 20 years ago would now be worth $120,000. By comparison, $10,000 in the S&P 500 20 years ago would only be worth $31,000. Total returns are not the only thing that makes Realty Income special. Look at these amazing dividends. They have consistently grown their monthly dividend payment since 1994 when they IPO'd. They have 89 consecutive quarterly dividend payment increases and 105 total increases since 1994. Their dividends have grown by a compound average annualized growth rate of 4.6%. That is amazing income this REIT is putting in your pocket every single month. Thanks to those consistent dividend increases, if you had bought the stock when they were first listed, your yield on cost would now be 34%. In other words, Realty Income would pay you 34% of your initial investment every single year. You would have been paid back your initial investment over 5 times by now just in dividends. Currently, Realty Income's dividend payout is 82.6%, which is good for a REIT. The yield is of 5.37%, which is its highest since 2013, indicating that this is a great time to buy. Realty Income has impressively had positive earnings per share growth in 23 of the last 24 years. They also have a beta of 0.4 versus the S&P 500. In other words, the share price of O is far less volatile, which is a positive for me. It has a $32 billion enterprise value, 51 years of operation, and is rated highly by 2 credit agencies, Moody's and S&P. As noted at the bottom, Realty Income is one of only 2 REITs with at least 2 A3 or A- ratings in both categories. This gives a greater sense of confidence and stability and shows that they are a very high quality company. Investors are often told to focus on diversification within their investment portfolio. The same is true for a REIT. You want to invest in a REIT that has diversification. This protects it against problems with the economy or the specific area of real estate the REIT is focused on. Realty Income is a well-diversified company across 6,483 properties. Their average remaining lease term is 9.2 years. They won't suddenly lose all their tenants because of how lengthy the leases are. Approximately half of their tenants are investment grade, which again suggests more reliable and safe real estate investment. They are diversified across tenants. As you will see here, Walgreens is the largest portion of the portfolio at only 6.1%, with most at or below 3%. The important thing here is if one of the many companies leasing from Realty Income goes bankrupt, Realty Income only loses a small portion of their income as a result. The top 20 tenants in their portfolio only make up 53.3% of their total rental revenue. Realty Income has specifically focused on companies falling in one or more of three categories they see as safer and more likely to survive economic challenges. The three are those which are service-oriented or experiential, non-discretionary, and low price point. If you think about how their tenants have fared in our current economic crisis, they have been thus far correct in their assessment of safety for all but gyms and movie theaters. Realty Income learned some lessons from the financial crisis and have significantly improved their portfolio since 2009. Take a look at this comparison. They have moved towards safer tenants, reduced the percentage of rent they receive from their top 15 tenants, increased the investment grade of their top 15 tenants by a significant margin, reduced the exposure to any one industry, and moved towards safer and more stable industries. Speaking of industries, Realty Income has ensured it does not have more than 11.6% of exposure to any one industry, spreading their portfolio to further ensure stability. In addition to these industries within the retail sector, which is 83% of their portfolio, they have further diversified by including industrial, office, and agriculture in their portfolio. They are also diversified geographically, as you can see in this map. Only one state, Texas, is in the double digits, and they have exposure to some extent in nearly all states and the United Kingdom. As further evidence of their quality, since 1996, their occupancy levels have never dropped below 96%. Obviously, empty real estate means no one is paying for a lease, and REITs want to maintain maximum occupancy at all times. Their record is stellar. Further examining their track record, their property investment volume is massive and has been rapidly growing. In 2010, their volume was $714 million for the year. You can see it has rapidly increased since, coming in at $1.8 billion in 2018 and a massive $3.72 billion for 2019. Similarly, their number of properties has significantly increased over the years. The 36% of investment grade in 2019 was a big drop from the 59% the prior year. However, they remain at 53% overall. Sourced volume has continued to rapidly expand and selectivity has remained consistently low. These are all great signs. I mentioned earlier Realty Income has learned some lessons since the financial crisis. You can see that clearly here. Since then, they have increased their available liquidity significantly. Their ability to cover fixed charges is much higher, their net and total debt ratios are more favorable, and their credit ratings are higher. Realty Income collected 82.9% of its rent in April, and I think it will weather this crisis well. Apparel stores only make up 1.1% of their tenants, and although some of their tenants are gyms, they have received or soon will receive hundreds of thousands of dollars in forgivable loans from government programs. Although the movie theaters in their portfolio may pose a problem, they are only about 6% of the portfolio. This is a good example of the importance of diversification. If we look at valuation for Realty Income, we can see it is currently fairly valued. In fact, this is the first time it has touched the fairly valued line since 2009, which is a great investing opportunity. If it maintains this course, we will see a 7.7% annual rate of return based on the 3%, 4%, and 4% expected increases in adjusted funds from operations, or AFFO, over the next 3 years. Realty Income usually trades at a premium, and I'm expecting it to continue to its typical price to AFFO ratio of 17.58. If it does, we will see a 13.6% annual return over the next 3 years. Fairly valued for Realty Income is a rare opportunity, and I'll be buying more and adding to my position. Although their debt has been growing quickly since 2012, their interest coverage for that debt is 2.6 times, which is sufficient to cover it. Their debt is also favorable compared to their industry. Long-term debt to equity is at the 24th percentile, and total debt to equity is at the 27th percentile. Which is your favorite real estate investment trust, and which are you buying now? Leave your thoughts in the comments below.
That is right, Ben. We are very interested to know what you guys think. Hope you really enjoyed this video. Thank you, and see you next time.
I look forward to hearing from you and learning from you. Don't forget to subscribe to both our channels because we will be creating new videos for you every week. As always, good luck with your investing.